Me, I'm one of the Scale Up partners. I work occasionally with Cole on various items, and Cole's run this event for us previously with very, very well received. So looking forward to what Cole's got to say. I'm sure Cole will introduce himself far better than I can, but for reference, he is the senior partner in charge of corporate finance at RG. And so, Cole, I'll hand it over to you.
Absolutely, John. Thank you very much. And good morning, everyone. Great to see some familiar faces, but likewise, excellent to see some new faces on the call this morning. The two things I just wanted to start by saying before we move into the subject of this morning's webinar is, first of all, whilst we have allowed a good few hours for this session, I suspect actually we'll cover the content in 90 minutes. And therefore, subject to Q&A at the end, I do think we might finish up by about 11 a.m. So hopefully get you guys on your way mid-morning. I'd love this to be a really informal, interactive discussion rather than a presentation. So as I go, if anyone has any questions, feel free literally just to interrupt me. If you'd rather, feel free to use the chat function. And similarly, you can email myself or John as we go or after the webinar if you feel it would be more appropriate if it is a confidential question you'd like to ask. So in terms of the subject matter this morning, what we want to spend a little time exploring is how to maximize the capital value of your business and how to realize that value, i.e. how do you extract pounds, shilling and pence from the share capital of the business that you are currently developing. In terms of how we're going to try and navigate this discussion, I think first of all, before you can appreciate how to maximize the value of your business, obviously one has to understand how a privately owned business would typically be valued. So we're going to spend a little time just talking through the methodology that is most often used to value a privately owned SME. I then want to talk you through the value levers that you can pull to very intentionally increase the value of your business as you are growing and developing your business. Sadly, head down, socks up, and improving pre-tax profit isn't in its own right the only way in which, nor the most effective way in which you can improve the actual capital value of your business. I think then I'd like to send you guys on a little journey by talking you through different ways in which you could realize the value of your business, giving you some examples of transactions we've advised on, whilst also giving you some hints and tips as to some quick wins that I think, if you implemented, could improve the value of your business in days. Before I maybe go on to introduce myself and my firm very quickly, I just wanted to dwell on the quote in the box, which of course is the fact that entrepreneurs, so people like you, spend their lifetime building their business from the ground up. And of course, it's therefore vitally important, isn't it, that you know how to maximize the value of your life's work so that at the right time, you can realize that value. And that's absolutely what we intend to cover off today. So in terms of introduction, as John kindly said, my name is Carl Swansbury. I'm partner at RG, which is the largest independent advisory and accounting firm based in the Northeast. And we are a full service advisory firm. And one of our 6 service lines is corporate finance. And I head up our corporate finance business. My background is PwC. I'm a qualified chartered accountant, and I actually joined RG 10 years ago to set up and scale our corporate finance business. So within RG Corporate Finance, we effectively advise entrepreneurial SME businesses and the shareholders of those businesses on all aspects of growth, change, and transformation. And that can include us advising pre-profit tech startup businesses on equity and debt raising, all of the way through to advising on the sale of that business at a future point in time, which allows the shareholders to realize the value of their effort. In terms of regional transactions that we've advised on of late, we advised on the sale of Van Mildert to Rightmove PLC. We, last December, advised on the sale of Sunderland-based Knights Network, which is a telecommunications business, to OneCom. We've advised a number of regional businesses on MBOs, including the MBO of eQuality Solutions, the MBO of Komatsu, which was exchanged last week and will complete at the end of July, as examples. So we've got a huge amount of experience in appreciating where value resides in a business, and therefore we know exactly how one can improve / manipulate that value in anticipation of a transaction. So let's try and put some context in place. So can you believe in the Northeast alone, there are 41,000 SMEs, which is, I think, quite staggering. You know, I thought I knew the market very well until I read that statistic and realized, actually, I've evidently got a lot of work to do, because I definitely don't know 41,000 SMEs in our region. And of course, what with certain sectors being prevalent in the region, I guess tech, business services and manufacturing being the three most notable examples, that is only set to continue. However, can you believe of that 41,000 SMEs, only 250 will successfully go through a capital transaction each and every year, which of course tells you that many SMEs are lifestyle and will never actually allow the shareholders to take off the table capital value, because they've not been positioned for or have not been developed in a way in which the business can be sold, be it to a trade buyer, be it to management, be it passing it down to employees through an employee ownership trust. So I think there is a lot of work for us to do in the Northeast to help SMEs ensure that their business is well placed, so that should the shareholders at some point want to think about, you know, extracting X million pounds of capital value tax efficiently, those options are made available. This slide here is just a summary of some of the transactions we've advised on in the Northeast, some of which, you know, may be familiar as a consequence of the size and profile of those businesses. So before I move into talk about how a business like yours would be valued, is there any questions at this stage from anyone? Is there anything that anyone might want to flag or ask? Super, excellent. Well, please honestly do stop me as we go if you do have any burning questions or want to challenge me on anything that I may say. So, the building blocks of value. How is a privately owned business like yours typically valued? There are three techniques that can be used to value a business. And those three techniques are discounted cash flow, asset-based, and earnings-based. And I would say 99.5% of SMEs in the UK will be valued on an earnings-based methodology. And therefore, for the purposes of this morning, guys, we're going to focus only in on the earnings-based valuation methodology. But I did just want to flag the fact that there are two others for completeness. So, what is an earnings-based valuation methodology? Well, an earnings-based valuation methodology looks to value today the future earnings profile or potential of a business, because anyone acquiring a business, of course, is acquiring a business in the knowledge that they will be accessing a future profit stream. And therefore, there are two elements to the earnings-based valuation methodology. The first part of the equation is to the left-hand side of the slide. So to calculate an enterprise value, or what you may more commonly hear described as goodwill value, So to arrive at the value someone's willing to pay today to access the future earnings potential of your business, the enterprise value, what we have to do is calculate the maintainable earnings of the business and apply an appropriate earnings multiple. So let's for now focus in on the maintainable earnings. In truth, all maintainable earnings is the operating profit of your business, adding back interest, corp tax, and depreciation, and then adjusting for any exceptional, one-off, non-recurring items which could have suppressed profitability or inflated profitability, and therefore adjusting for them would enable you to find a more maintainable, more normalized earnings level. Okay, so some examples of adjustments that you would have to make if you wanted to calculate your business's maintainable earnings would be to add back any bad debt expense. You know, if one of your customers, sadly, as a consequence of COVID, hit the wall and you had to write off £10,000, then that expense is an expense you wouldn't see year in, year out. It's exceptional, it's one-off, and therefore the bad debt expense you would add back to your operating profit figure. Similarly, if maybe during COVID, sadly, you needed to make redundancies, any legal and professional fees and any redundancy payments made would be added back to operating profit when calculating maintainable earnings, because of course, one would definitely deem those things as being exceptional and one-off. Similarly, you would add back any excessive remuneration. So if any of you guys have a very luxurious lifestyle and you find yourself extracting significantly more remuneration through payroll than maybe you would pay your equivalent if you were to replace yourself, then likewise, you'd add back that excessive director remuneration. So those are all of the things you would add back to increase your profit figure. But of course, where there are things to be added back, there are things to be deducted. And therefore, similarly, any income that the business receives, which is non-recurring or exceptional, would need to be deducted. So if I give you an example, if you received as a consequence of COVID, any grants from the council, of course, nice to have, but one-off, they would be deducted from profit when calculating maintainable earnings, because let's all hope, you know, COVID starts to dissipate and we don't have to see those grants received again from the council. Similarly, the business may have other grants from councils. The business might have rental income in relation to a freehold property that maybe you own outside of the business. And therefore, if you sold your business, of course, that rental income would not be received by the business moving forward. Once you've made those adjustments, you get to a maintainable earnings figure. So that's the profitability of the business that a buyer or a third party would believe that they will be able to access and benefit from were they to buy your business. And therefore, that is the maintainable earnings figure that would be used for the purposes of valuing your business. The second part of the equation is the multiple. So how do we arrive at the multiple that would be used for the purposes of valuing your business? Because if your business is delivering an adjusted operating profit or a maintainable earnings of £500,000, then of course the multiple is so important, because if your business is valued at a multiple of 4 times, that would give you an enterprise value of 2 million. But by just increasing that multiple by 1 multiple point to 5, that increases the value of your business by £500,000. So establishing the right multiple is really important, and knowing how to manipulate and improve the multiple likewise. So how do we establish a multiple that would be used to value your business? Well, first of all, you might look at the Financial Times and look at businesses that are listed in the same sector as your business. Listed companies that are listed on the London Stock Exchange or the AIM market will have a disclosed price earnings ratio. And effectively, that is the same as a multiple that one would use for valuing a business. So for instance, if your business is an IT recruitment business, you could look today at S3, which is a listed IT recruitment business. And if their PE ratio is 15 times, then actually that's a good place to start. However, what you would of course need to do is to discount that PE multiple quite heavily to take into consideration the difference of scale and the difference in size between your business and that listed business. Often that adjustment can be anything from circa 40 to 60%. So that's one way in which you could establish a multiple for the purposes of valuing your business, bearing in mind multiples are very sector dependent and vary quite significantly. The other thing that you could do is look at deals done in your sector to see what multiples have been paid for businesses like yours. Again, if there was an acquirer who bought a competitor of yours and that acquirer was listed, you'd be able to establish pretty quickly what multiple of earnings that buyer paid for the privilege of acquiring that business. And of course, as a corporate finance house, we have a significant ability to carry out that research globally by sector as a consequence of the research tools we use. Those are the different data sources that you can use, but the reality is a lot of it comes down to judgment and whether your business is valued at a multiple of 3 times or 6 times, yes, will be in part dictated by the sector in which your business sits. But it will also be affected heavily by the scale and size of your business, because smaller businesses attract lower multiples, and that's because they are seen as less scalable and carry more pregnant risk. Because of course, if 1 or 2 members of your staff were to leave and you are a small business, then that can have a huge impact on the viability and performance of the business. Whereas if you're a larger business, 2 or 3 resignations wouldn't really have a notable impact. Similarly, where your business is in the business's life cycle has a huge impact on multiple. Because if you are an early stage business, you've proved concept, you are generating revenue, but you haven't really yet proven that there is a significant addressable market. You haven't put in place a senior management team, you haven't got robust systems, processes, and procedures, then of course that business will be less attractive and therefore will attract a lower multiple than if you are a mature, well-developed business that has already developed a significant scale, has a large percentage of the addressable market, because of course that type of mature business naturally would find itself receiving a higher multiple. Similarly, one thing that will have a huge impact on the multiple that you can attract is whether you have contracted or predictable revenues. Morning, Kim. Good morning. Welcome to the call.
Morning. Thank you. Sorry about that, guys. I had a bit of a trouble with the link this morning.
Hey, no problem, Kim. Feel free to make yourself at home. And I was just saying to the guys, as I go, if you have any questions, Kim, or there's anything you'd like to chat through, please just shout out.
Great. Thank you very much. Cheers. I appreciate that.
No problem at all. If you are a business that has contracted revenues, so a SaaS business, or a business that has 2-year contracts, which give you a greater degree of revenue visibility and predictability, then of course your business will attract a much higher multiple than a business that has no contracted revenues. And in fact, if you are a SaaS business or a contract revenue-led business, then actually what you can also find is that you may find yourself being valued not based on a multiple of adjusted profit or maintainable earnings, but actually you can find yourself being valued at a multiple of GP or turnover or annual recurring revenue if you are a SaaS business. So again, isn't it interesting if you are a tech business, thinking about how you might, when engaging your clients, look to contract with your clients for a longer duration. And at the end of a contractual period, why not just assume that unless notice is given, you find yourself entering into a new 24-month contract? That can have a huge impact on the multiple you would achieve were you to be anticipating the sale of your business. So in terms of a worked example to try and help establish how we do go about assessing and landing at a multiple that is appropriate, we've got a brief worked example here. So if there is a business, North East Co Limited, and it generates a maintainable earnings or an adjusted operating profit of 1 million, and the business is owned by 2 shareholders. To calculate our enterprise value, of course, we need to establish a multiple. So what you can see here is how we go about calculating an average multiple for the purposes of valuing the business. So the range of comparators is us looking at listed businesses. We then, of course, look at those listed businesses that are of a comparable size to your business. Bearing in mind, some of the listed comparators will be significant global corps and therefore arguably not comparable without applying a heavy discount. We'll then look at recent deals done in your sector, and then we'll form an assessment. And as you can see, that's effectively an average. And we therefore feel North East Co Limited would be valued at circa 4 times maintainable earnings. And of course, the maintainable earnings we said in this example is 1 million. Therefore, we get to an enterprise value for this business of £4 million. Clearly, one therefore wants to do all you can do to maximize the multiple that you achieve on sale of your business, because it can have a huge impact on the value you ultimately receive. This is the first part of a 2-part valuation equation, because the enterprise value is the goodwill value. But what it doesn't do is take into any consideration your balance sheet. And of course, if you are selling the shares in your business, the buyer acquires the shares and assumes the balance sheet. The buyer ultimately inherits your balance sheet, and therefore it's of course incredibly important that when you are looking to establish the value of your shares or the value of your equity, that consideration is taken for the balance sheet. Because in this example, I'm sure Tom and George would be pretty devastated to find that they would be selling their business for £4 million if in fact they had £2 million of cash in bank. So there needs to be a mechanism for allowing, of course, Tom and George to be able to benefit from the balance sheet that they have built up over many years. So in terms of how we get from enterprise value, which is 4 million, to equity value, this is the final part of the equation. So once we have our enterprise value, which in our worked example, guys, is 4 million, what we then have to do is to deduct, based on the business's most recent balance sheet, any debt in the business. And that is because the debt within the business, you will leave with the business, and the acquirer would inherit that debt, therefore be liable for servicing that debt. And therefore, naturally, that has a negative impact on the equity value of the business. Any cash on the balance sheet would be added, because effectively you are selling that cash. The buyer would buy the cash, and therefore we would want the buyer to pay to you for that cash on a simple pound for pound basis. The benefit of that, of course, is that rather than you having to dividend that cash from the business and pay income tax, as a consequence of how an equity value is struck, the buyer purchases the cash pound for pound, and therefore you receive that cash consideration as part of the capital consideration you receive on sale of your shares, which of course means you pay capital gains tax on that cash rather than income tax. And therefore you're paying CGT at 10% if you are entitled to entrepreneurs relief, or indeed 20% full rate CGT. So you will be deducting debt, adding cash, and then the final adjustment is to allow for normalized working capital. So what level of liquidity does the business need to operate and to, on a day-to-day basis, meet its current liabilities when they fall due? So those are the three parts of the enterprise value to equity value bridge. And of course, once you get to the equity value, you know, surprise, surprise, we know the value of your equity, the value of your shares, and that's the number that matters. So in terms of those three categories of adjustment, so debt. So what items on your balance sheet would be deemed debt? So you can do a fag packet calculation today to value your own business. Well, a debt item would be a bank loan. You know, many businesses have taken C-bills or bounce back during the COVID period. Those loans would be debt. They would be deducted from enterprise value. Hire purchase liabilities, likewise. A corporation tax creditor, likewise, is debt-like, because of course the liability would crystallize under your ownership, but is typically paid, you know, 9 months after your year end. Therefore, the buyer would want that to reduce value because the buyer will have to settle that liability with HMRC on your behalf. Other less obvious debt-like items, which might not be as immediately obvious, could include things such as invoice discounting. So if your business has an invoice discounting facility, that would often be considered a debt-like item, and that would reduce, therefore, equity value. Similarly, if the business has, over a period of time, received monies from you, the director shareholder, of course, that would be a loan because that would naturally need to be repaid and therefore would be a debt-like item. The only other thing that is often a debt-like item would be dilapidations. So if you've got 2 leasehold locations, you're stuck in a 10-year lease, and at the end of the lease, because you've completely changed the use of the leasehold property, there's likely to be £100,000 of dilapidations. Then really, you should be accruing for those dilapidations annually. That accrual would be a debt-like item because that will be a cash outflow at the end of the lease from company to landlord. So those are the debt and debt-like items that we see very often, and they will all be coming off enterprise value. In terms of cash items, that will include any cash in bank. It will include any loans to employees or directors, because of course they will be repaid, and on repayment will convert into cash. Other cash-like items might include rental deposits. So if you paid, when you entered into your lease, a £5,000 rental deposit to the landlord, then of course, on the other side of a transaction, that rental deposit would come back in the form of cash, and therefore that should be a cash-like item. So those are the cash-like items. Finally, there's an adjustment for working capital or normalized working capital. And very simply, all we're doing here is we're looking to adjust against the actual working capital of the business at the time of valuation, for the normalized level of working capital needed, the difference being a positive or negative adjustment to price. So just to quickly run through the worked example of earlier, putting some numbers to this. So if the enterprise value of your business was 4 million, as is the case for North East Co, and there was a loan, a C-bills loan of £1 million, that would come off. Cash in bank or other cash-like items of 2 million would be added. We then think the business needs, on a normal basis, £1 million of cash to fund working capital. And by that, I mean debtors minus creditors, typically tracks at £1 million. But at the time of valuing the business, there was only £500,000 of cash tied up in debtors minus creditors. there'd be a negative £500,000 normalized working capital adjustment. And therefore, once you run those numbers, you get to the shareholder value or the equity value of the business of 4.5 million, which would be split, of course, between the two shareholders, 50-50. Before we talk about some of the ways in which, therefore, you can actually manipulate / increase the value of your business, does anyone have any questions at this point or anything that they might want to share or discuss? Grand, super. As I said, guys, as we go, please, any questions, do just stop in your tracks and feel free to unmute and raise them. Or likewise, do feel free to send out those questions via the chat. Okay. And just to ask, actually, I can see someone's just put a message out on chat asking whether or not the slides are visible. Presumably, guys, everyone can see the slides. Great.
No, but I've resolved it another way, Carl. It's okay. John sent me a copy. So unfortunately, I can't. I think it might be user error, but there's no option for me to view them.
How odd. Presumably, everybody else can see the slides. Great, good. Yes, delighted. Otherwise, yes, the last 30 minutes would have been difficult for you, for sure. Okay, good. So hopefully now we've all got a better insight into how your business will be valued. And of course, knowing how your business would be valued is really important for many things. I mean, first of all, insurance purposes. You might be putting in place Keyman. Knowing the value of your business will help you do that. Similarly, you may be going through a transaction. Maybe that involves selling the business and or looking to bring in equity investment. Again, knowing the value of your business is important. And there are many other reasons as to why one would want to know the value of your business. So hopefully you've now got a much better appreciation as to how your business will be valued. So what are the value levers that you can pull over the coming weeks, months and years that would help you increase the enterprise value of your business? And indeed, we'll move on to talk about the value levers you can pull that would improve the equity value of your business just in a moment. But of course, the two ways in which you can increase the enterprise value of your business are by, first of all, increasing your profitability. That sounds obvious, but one less obvious way of doing that, over and above continuing to grow your business organically, is actually by making small bolt-on acquisitions. That may give you access to a new product area, a new service proposition. It might give you access to a new geography. It might get you into new contracts or onto new frameworks. It actually also simply might give you more scale. Because if you, for instance, were today a £500,000 maintainable earnings or adjusted profit business, let's say you are, a business within the soft FM sector, you might be valued at 4 times. But if you were simply the same business but double the size, because you have more scale, because you are a business that carries less risk as a consequence of less concentration when it comes to clients, employees, etc., that same business would probably be valued at 6 times, not 4 times. And therefore, one real reason why you may acquire a business is to acquire a smaller business, pay a multiple of 4 times for it, knowing fine well as part of your business will be valued at 6 times. The arbitrage is clear. So that is a way in which you can increase your maintainable earnings and indeed the multiple that you'd attract as a consequence. Of course, acquiring a business will also enable you to drive cost savings through the combined business, which again will naturally improve EBITDA margin and your EBITDA on a pound basis. How can you increase the multiple then? Because of course, you guys as business owners will every day be doing all of the things you do in pursuit of profit growth. But how can you increase the multiple? Because I guess that's something you probably think less about and probably have less of a focus on as you go about your running of the business day to day. So what can you do to improve the multiple that your business would attract were it being valued? Well, the first is, where possible, try and enter into contracts or try and create a degree of predictability within your revenue stream. Because not only will that increase the multiple, because anyone valuing your business would be able to predict with more confidence and certainty the future revenue streams of the business, but you might find actually you can go from being valued at a multiple of EBITDA or operating profit to a multiple of annual recurring revenue, which of course is step change. And to give you an example of that, so I mentioned at the beginning that I sold a business called Van Mildert, which was a tenant referencing business, to Rightmove PLC for 20.1 million. That was a really interesting transaction because Van Mildert as a business in the year in which we transacted was a 1.6 million adjusted EBITDA business, but we sold it for 20 million. And that is a consequence of the fact that it was a business that had contracted revenues. It was providing landlords and letting agents with volume tenant references, but they had all of their clients engaged in a 12-month contract, which gave Rightmove real confidence over the future revenue visibility of that business, hence why they were willing to pay a very full multiple and value for that business. That's a really important one. And often businesses that don't think they could put in place contracts can. They just need to go about the way in which they engage with their customer base maybe differently. The next thing that will have a huge impact on multiple is scale. And by scale, I mean not only the pound note profitability of the business. Typically, a business generating adjusted EBITDA of north of 500,000 starts to become far more attractive to acquirers, and therefore the multiple starts ratcheting up. Less than 500,000, often that business can be considered, often disrespectfully and wrongly, but nonetheless can be considered by a buyer as a small subscale business. Because it's a small business, it might not have a developed management team, it might not have robust systems, processes and procedures, it might be a Me Too business, certainly doesn't have large market share and therefore naturally would command a low multiple. So increasing the scale of your business in terms of the pound note profitability of the business can have a huge impact on multiple. And that's why, of course, a lot of businesses go out and acquire smaller businesses because they pay a lesser multiple for the privilege of acquiring a smaller business. But as a consequence of being part of a larger group, the smaller business's earnings profile attracts a higher multiple when within the larger group as a consequence of arbitrage. The other area of increasing scale is all about making sure the business is scalable. So are you a business that operates in one jurisdiction? Could you be exporting? Could you open up other geographical markets? What about your CRM, your accounting system, your compliance processes, your back office systems? Are they scalable or would they crack if you try to put volume through your business? Your sales strategy, is that dependent on you? Or do you have a sales manager or sales director? Again, you can't scale a business if the only person running the business is you. You will always be the greatest asset and the single reason why the multiple that you achieve on sale will be definitely held back. Similarly, headcount. How many employees do you have in the business? Do you have capacity in the business? Is there latent capacity for scale? Or are you at capacity? Do you not have any ability to grow beyond your current size without having to add and invest in headcount, systems, processes, and procedures? And of course, a business that has grown and is growing and has demonstrated scalable traits will be far more attractive to trade buyers and or private equity, because of course their intention is to continue to scale the business under their ownership. And of course, a business that has demonstrated an ability to scale will attract a higher multiple. A really important point, which is often not fully explored and understood, is the importance of a very experienced senior management team and board. You know, how experienced, how knowledgeable, how able, how profiled is your leadership team who run your business? Is that team independent of you or completely dependent on you? Because of course, you know, fast forward 10 years, if your intention is to potentially see your business sold so that you can take £5 million of capital value off the table and potentially jump on an aeroplane and head to Dubai, as and when, of course, Dubai is on the green list, you can only possibly do that if you have within the business a collection of individuals who are able to run the business post your involvement. So are you developing that sort of senior management team who will become maybe in the future your successor? And of course, if the answer is yes, then that management team who will continue to scale the business post your involvement will be well received by a potential acquirer, and naturally that will have a positive impact on value. The other thing that you can do to hugely increase multiple is to reduce what we call reliance risk. And reliance risk is evident within many areas of a business, but as examples, customers. Do you have one customer that contributes more than 10% of your overall revenue? And if the answer is yes, you have one customer and that customer contributes 75% of your revenue, then of course there is huge reliance there, because if you lost that customer, the viability and profitability of your business will be compromised. So how can you reduce reliance on that customer? Of course, one way is by scaling, bringing in more customers. You'll not do less business with that customer, but proportionately as a percentage, you will do less business overall with that customer. Often people may say, well, Carl, that's all very obvious and in principle, the right thing to do. But, you know, we have one key customer. We've worked with that customer for 30 years, and we're not going to cut our nose off to spite our face. I'd say totally understand. If we don't think there are any other customers we could work with to reduce overall reliance, maybe what we do with that customer is actually enter into a more contractual arrangement, because that will reduce risk in itself. So you have one customer, it's a very important, sizable customer. That customer knows that they do a lot of business with you, and they are probably as equally dependent on you as you are them. Why not talk to them about a contractual arrangement, which would give you more revenue visibility? It would give you more confidence when investing in growing your business, and naturally would help counteract the reliance risk, which would have a negative impact on multiple if not managed. Reliance risk is also evident in employees. So do you rely on any one or any handful of individuals to run your business? Do you have a shadow person beneath those key individuals? Or are you relying on one salesperson to do all of your new business and BD? Because of course, if that individual leaves, you know, you're going to be in a bit of a sticky predicament. So when you have reliance on few individuals, again, you may say, Carl, I'm a small business. I can't possibly have more than one sales manager, because with respect financially, you know, the business couldn't support that person or any other additional persons. I'd say I totally understand that, because that makes sense. But what can you do to reduce the perceived reliance on that one individual? And the things you can do include things like bringing that person into some sort of share option scheme, or maybe rather than commissioning that sales manager in the normal way, i.e., you know, he or she is targeted and they receive, you know, a monthly commission, why not link their remuneration to the company's profits and pay to them an annual profit bonus? Could that be a way of tying them into the business for longer and encouraging them to help you grow the profitability and value of the business. Similarly, non-competes and restrictive covenants. The sales manager, who you rely on entirely, is he or she in a position whereby if they were to leave the business, they can take your business with them? Or do we have in place sensible restrictive covenants and non-competes that would restrict them from competing with your business for a sensible period of time were they to leave you? And I guess the only other important thing is to always be mindful of the contractual terms you have in place with any key employee, because of course, as part of any transaction, they will definitely be dusted down and referred to. So that's what I mean when I talk about reliance risk. But of course, that reliance risk can exist not only in the area of customers and employees, but similarly suppliers. So do think that through. And if there are risks, address them. And if you can't address them, reduce them, because they will impact multiple. And honestly, I mean, the multiple point can increase from 4 to 6 by just managing and reducing these risks, accepting that, you know, a small SME will always, in certain instances, find itself relying on few employees and few key customers. That doesn't mean to say you can't mitigate and dilute that perceived risk. So those are some of the things that you can do to impact multiple. I've summarized in this slide here some of the things that also need to be considered when looking to maximize the multiple that you would receive on sale. And some of these we've discussed, guys, as we've gone. So I've talked about customers, those customers being contracted, there not being undue reliance. We've talked about supply chain and where your business sits within. What we haven't talked about is the business having a clear business plan, which it can demonstrate to anyone that the business is absolutely committed to executing. Because of course, the business that has a clear vision and a business plan supported by a financial model, which is being executed and can be demonstrated to having been executed over a period of years and months previously, that business will be far more attractive and investable than a business that, quite frankly, is winging it. Because of course, if a buyer is to acquire a business, they are doing so to continue to scale it. Therefore, showing the buyer how they can scale the business is not only going to likely excite them, but of course it will have a huge impact on attractiveness and multiple. I think the only final point on this slide worth just mentioning is the sort of legal, regulatory and market environment in which your business sits. Clearly, certainly over the last 2 years, what with Brexit, what with COVID, what with sort of certain tax changes around IR35, there's been a lot of new regulation introduced which can, if not managed, negatively impact a business. And therefore, it's really important that you are aware of the regulatory environment in which your business operates, so that not only are you compliant, but more specifically, that actually you can see that you can continue to be compliant as you scale. And I think a good example of that is a recruitment business placing contractors. 2 years ago, there was not really any thought given to whether a contractor was self-employed or not. And actually, a lot of contractors were self-employed just for tax purposes, but were really employees and should have been paying income tax and employee NIC. Well, of course, Income's IR35, which has absolutely ran a red rag through that. And therefore, that market and any business within has completely had to rethink how it delivers and how it manages that sort of IR35 risk. So these are all of the things that we should be thinking about, because these things will impact attractiveness and multiple.
Can I ask a question? Sorry, I'm interrupting.
Please do.
What about the positive impact of any regulation? I operate in the property industry and there's pending regulation. So could that have a positive impact on the basis that I'm operating in a market that my product might support that regulation?
Absolutely. Great question, Charlotte. And yes is the answer. And similarly, where there is deregulation, that could open up a bigger market opportunity and therefore naturally would make that business a more exciting business. And therefore that should positively impact multiple, Charlotte.
And when do you need, so the regulation in our industry is not fixed in stone yet, it's a mumbling. So do you think businesses take a gamble on the fact that it's coming in, or do they wait until there's certainty, and how would that affect value?
Yeah, so that's a really, really good question. So if a business is anticipating a transaction, so a sale, and they can see that there's going to be positive changes to the legal and regulatory environment in which it sits within, then I suspect that any acquirer, bearing in mind they are likely to know your sector, and therefore they likewise will appreciate the changes that are coming down the track. They will want to acquire and invest in that business early so that they can be poised to take full advantage. And therefore what you'll find, Charlotte, is, the likes of a Rightmove or a Zoopla, they will buy early because they'll have an ability to diligence from a legal perspective what the likely changes are to look like and the impact that would have on their business and the business they are acquiring.
And Rightmove is my target, who I'm talking to already in sort of very early stages. Yeah.
Good. Well, and rightly so. I mean, we've advised on a lot of prop tech transactions over the years.
I'm good friends with Christian.
Are you? Excellent. Well, Christian's a great guy, as you will know, and a brilliant guy and a very good businessman. And it was a pleasure to advise him and Richard on the sale of Pan Milden. But as a consequence of that and many other transactions we've advised on in the space, we definitely would want to understand the likely impact changes would have on your business, and we present those positively to any acquirer we were approaching, wanting the acquirer to acknowledge that now is the right time to acquire the business for those very reasons. And of course, Charlotte, they would diligence that. Yeah,
because we're still quite early in our journey, but we're ahead of the game in terms of the marketplace, so it's exciting. Thank you for that.
Pleasure. Thanks, Charlotte. That was a great question.
Okay. Can I just chip in with a question as well? Is that all right?
No, please shoot. Absolutely.
Yeah, great. Thank you. It's just with regards to contracts. If you had a customer who you predicted an income of around 200k for the year, is it still worth getting in a contract for a lesser amount of around 50k? Like, what's the kind of, is it still worth getting something in place if you think they would sign something for a minimum of 50k but not the 200?
Yeah.
Is that still worth doing?
Good question. And the answer is yes. I mean, for two reasons. First of all, it'll probably just help you sleep a little easier. If you know you've got a minimum level of contracted revenue, that's just good business, right? So the answer is yes to that. And what it also shows to you and to any third party looking at your business is that whilst you've got a contracted revenue line with that customer, actually there is a huge amount of potential within that customer, which is more spot non-contract business.
Right. Okay. That makes sense. Yeah.
So without doubt worth doing. And to Charlotte's point earlier, prop tech businesses often are businesses that will provide software as a service, or they'll sell licenses. But either way, these are volume transactions and often low cost point. And the contracts therefore are, $29.99 a month based on X number of users. So it's not a huge amount of value that's contracted, but it's the business model that's important because all of their revenue is contracted.
That was my next question, because we've just started to put some of our products on subscription. So again, I was asking whether that would be kind of taken into account or not. But okay, great. Thank you.
That's really exciting. So any business that has subscription revenue or software as a service or licensed income, that's all sticky. That's all going to give everyone a degree of confidence that there is visibility over future revenues, and that will go to multiple. And if you can find that sort of north of 60% of your total turnover is underpinned, whether it be contracts, whether it be SaaS, whether it be licenses, then actually what you often see is very quickly you can take a buyer away from a multiple of profit to a multiple of annual recurring revenue. And that is step change.
Great. Okay, amazing. Thank you. Cheers.
I've
Pleasure.
got one more then. So if we're a bit of a SaaS model and we don't contract at the moment, but we're looking to contract. So with a SaaS model and it is a recurring revenue, do you still need the contracts? How do you balance the two together?
Yeah, so just to ask, how do you currently engage with your client, and what is the charging structure, Charlotte, just so I understand,
We
please?
charge a monthly amount for user licenses to access training, online training content. And at the minute, we haven't got any minimum period, but we want to go to the fact that they have to sign a contract for a fixed term because we know that will keep them with us.
Yes,
So we just charge like that at the moment.
understand. And presumably right now they could give notice therefore,
And they could leave within a month. We've
Yeah.
done that deliberately because because training in our industry is quite new and e-learning is quite innovative. So we wanted to give them flexibility to come back if they needed to without feeling they were tied in, just from an early days of the business and a brand awareness point of view more than anything.
no, well, it's great to do that. And of course, it demonstrates from your perspective, great confidence in the training you provide, because you're saying clients, if you don't think our training's additive, you can disengage us. So that's a really important sell tool, right?
Yeah.
In answer to your question, I think the fact you are a SaaS business will mean you will be valued based on a multiple of revenue. But of course, what the multiple is will largely be dependent on whether you are contracted.
Yeah, great. So the more we can build that. And in a SaaS business, are you trying to contract for 12 months or is it shorter terms or?
Yeah, minimum 12 really, Charlotte.
Yeah, cool.
Yeah.
Okay, that's good to know. Thank you.
So if you had a SaaS business and most of your, or a lot of your clients are on 12-month contracts rolling, that is the perfect business model. And therefore you'll be maximizing the multiple you receive as a multiple of annual recurring revenue at the right time. Thanks, Charlotte. Great questions. Okay. So we've talked there about how you can intentionally go about increasing the multiple that a third party would use when valuing your business, or in fact, you might use yourself if on a Sunday afternoon, you fancy knocking yourself out and establishing what your business is worth, having spent many, many years building it. Let's now talk about some less obvious value levers, because I think that, increasing profitability is what we're all trying to do. And of course, being aware of multiple also might be something that was already on your radar. But I must say the one thing that very few owner managers even think about is how the balance sheet can impact equity value. Most owner managers think the balance sheet is just what's left at the end of the day and therefore shouldn't be proactively thought about. But of course, that's not the case. So what can you do to increase the equity value of your business, or the value of your shares, without having to increase profit or manipulate multiple? Because these are all things you do in-house. Yes, they'll have commercial implications, but these are all things that arguably you can just do. And therefore, my question always would be, why wouldn't you? So the first thing you can do is to try and make sure that you, to the extent possible, reduce any debt in the business, because that will of course increase equity value, and therefore that means repaying any loans, repaying any RCF facilities, etc. Similarly, improving cash generation, i.e. getting more cash out of your debtors sooner, will mean the business needs less working capital. It will have more cash, and then of course that positively impacts the two elements of the EV to EQ calculation. And of course, reducing working capital tie-up also will increase cash and reduce the level of normalized working capital to buy things you need. So a couple of sort of specific examples of things that we do with our clients. So you may have a supplier, and you might purchase, steel metal from that supplier, and you may pay 30 days after month of invoice. Well, what would that supplier afford you if you were to agree actually to pay 60 days after date of invoice, i.e. would they let you extend your payment terms? If that supplier is a close supplier of yours, you have a good relationship with them, then they might be very relaxed about you guys paying their invoices 60 days rather than 30 days. Of course, that would have a huge impact on working capital, because effectively what it means is you need less cash day to day to run the business because you're paying for your raw materials over a longer period of time. So that would positively impact cash, and it would reduce the normalized level of working capital you need. The one thing that I always find quite interesting is often my clients will say, Carl, we always pay our suppliers quickly, and they're always proud. And there's nothing worse than when I send an invoice to a client and they settle it same day. That's so frustrating. Because of course I'm saying, you have 30 days to settle my invoice. Why have you settled it today? Because what you've done is you've actually demonstrated that you need more cash in your business to fund working capital, because I guess the way in which you've gone about settling supplier payments suggests that you are settling those creditors earlier than required, and therefore there's a precedent set. So don't early pay creditors, pay on time and try and extend those payment terms. With debtors, if you can go to a SaaS model, or you can go to a monthly sort of direct debit model, then of course you get that cash quicker. And if you're not ever going to be that business because you're a widget manufacturer and you sell a product, then actually, why don't you offer customers an early payment discount to get them to settle invoices early, get that cash in early? You've got less cash stuck in working capital, you've got more cash in bank, that goes to the value you get. So these are all obvious things, but I think when you're sort of so busy running a business and growing a business, often you don't revisit your contractual terms with customers and suppliers, and you just sort of put them to one side and, you know, forget about maybe some of the earlier contracts that were entered into. So do revisit them, especially at this time, whereby arguably I'd suggest some of your suppliers, you know, would appreciate the idea of talking to you about payment terms. And let's face it, some of your customers, you know, if your customers are going to get a discount for paying early, they probably will. So do think about these things. I think the only other thing to mention on sort of the EV to EQ adjustment area is to make sure that as a business, you do have monthly management accounts which enable you to track all of the things we're discussing. So, you know, can you now tell me at the end of May, you know, what your cash items, debt items, and normalized working capital were? Because of course, if the answer is no, then you'd find it incredibly impossible to ever establish the value of your business. And of course, a buyer will typically want to see that information for a good 12 months looking backwards. So you're going to have monthly management accounts for a good year or so before entering into any sort of process involving a potential transaction. So I'm just going to pause for a second, because we've talked now about how your business will be valued and what levers you can pull to improve its value as you go about building and developing the business. Before we talk about how you then extract that value, which is the exciting part, because that's what delivers into your back pocket, pound, shilling, and pence. Any questions at this stage? Because I know there's been some really great questions asked, so I want to make sure any questions that are at the forefront of your mind are given the opportunity to be answered.
Just one more quick one. So you said about offering discounts for early payment. Would that apply in a SaaS model if you pay 12 months up front? Would that be a benefit to your business, or is it better to keep it on the direct debit, you know, monthly payment?
That's a really, really good question. So a lot of businesses do what you've just said, as you will know, given the nature of your business. However, if you think about actually how that impacts value, so let's just run through it. So if you had a 12-month contract with a client and you knew you were going to therefore be able to access 12 months of income over that 12-month period, then I would question whether there's any benefit in offering a discount to that contracted rate for the benefit of receiving the cash in month one. Reason being, obviously the discount will mean you will reduce your run revenue. It's the revenue that will be multiplied by a multiple to arrive at the enterprise value. If you were to have contracts spanning calendar year and you sold your business at the end of March, then actually any cash that you received in January, which relates to that 12-month period, actually would be accounted for as follows. The first 3 months, so Jan to March, of that cash relates to revenue that would have been generated pre-completion. That cash would have been for the benefit of you, therefore added to equity value. However, the 9 months of cash from April to December actually relates to services that will be provided by the acquirer when your business is under the acquirer's ownership, and therefore actually that cash that you've received actually wouldn't be added to price, because actually that's cash that will only be released by the buyer when the services are provided under the contract.
Okay.
And therefore, in that instance, actually, you are probably better off in truth not offering, a discount to a customer for the privilege of entering into a 12-month contract, on the assumption you can get that customer into a contract without.
Yeah, exactly that. Yeah.
But if you can't, then of course it is, because the contracted revenue is what we're after there.
Yeah.
Yeah.
Yeah. Cool. Thanks.
Great question. Okay, so let's now talk about how you can realize value for your business. I think that the first thing I'd say is that every single business and the shareholders of every single business have a very different outlook. They will have founded the business for different reasons. So, you may have founded your business because actually you want to address a need that you've identified. You may have inherited your business from your parents. You may have set this business up with the sole intention of scaling the business and selling the business for £10 million by your 50th birthday. You may actually want a nice lifestyle business. You may want to really enjoy what you do. You might want to enjoy who you do it with, and you might want to earn a good living. And you might never really want to have to, nor might you ever want to need to see your business sold. And therefore, what's really important is that the shareholders, you establish why it is you set up your business and what it is you're trying to achieve. And the earlier you do that, the better, because that will help you establish how relevant some of the things we're discussing this morning are. Because let's face it, if your business is a lifestyle business, you'll never sell your business. You will hold your business until retirement and then put it into an orderly wind down. Then actually, some of the things we're discussing are just less relevant. It's all about enjoyment, making sure you're being tax efficient and maximizing what you earn from the business. But capital value is probably less so pertinent to you. So once you've established what it is you are aspiring to achieve with your business and from your business, of course, you can then start to work backward. And I always like to sort of plan with the end goal in mind, certainly when it comes to time horizon. So when you are thinking about potentially realizing value for your business, and assuming that you think that event will involve the sale of shares in your business, then of course there's a couple of things that you just need to be considering. The first is, is there within the business succession? Is there someone within the business who could buy the business? If not, is there a team within the business who can run the business without you? And of course, if there is succession in the business, that might involve you simply passing down the business to your children. That could be through a sort of MBO type transaction. It might also involve you passing the business down to employees through an employee ownership trust, which means the capital you receive tax-free. Can you believe it? Also, I guess retirement should be on your mind, because we all have a line in the sand, don't we? And sadly, at some point, we'll all drop off our respective perches, and therefore, we do have to, I think, have a real degree of visibility as to when we would like to retire, because that should in turn help you plan and to work backward from when you would need to start actually thinking about a process. Another time when you might find yourself thinking about a potential event is if you are approached by a third party. But again, the thing I see so often, which is such a shame, is you will spend a lot of your time just focusing in on running your business. You'll spend probably little time anticipating how your business would be perceived from the eyes of an acquirer. And if you are approached, so we talked earlier about Rightmove. If Rightmove approached you now, would the business be in a position to actually enter into a serious, focused conversation? Is the business positioned to transact, or actually have we got a lot of homework to do? And if the answer is we've got a lot of homework to do, then of course no time like the present. So I do think always try and be as ready as possible to receive an approach, so that should you wish to want to, you can respond to it positively, accepting you may not want to. Another thing that might help you decide when is the right time to transact is tax. And as a professional advisor, as a qualified accountant, I always say we should never let the tax tail wag the dog. However, I must say we've got to be mega conscientious of tax, because right now in the UK, if you've not sold shares in a trading business before, and you do now, the first $1 million of proceeds, you pay capital gains tax on at 10% as a consequence of Entrepreneurs Relief. Everything after $1 million, you pay capital gains tax on at 20%. In the autumn budget last year, Rishi Sunak made it very clear that as a consequence of the debt pile that the UK government have built up as a consequence of COVID, not only will capital gains tax be reformed, i.e. Entrepreneurs Relief might be removed and or reduced, and the main rate capital gains tax will increase, but he also said that the main rate CGT is likely to slowly start to become in line with income tax rates. And of course, if you are a higher rate taxpayer, that could mean rather than paying, let's say your business was valued at 5 million and you and your partner own 50% of it each. So on a 5 million sale today, you and your partner would pay 10% on the first million and 20% thereafter. It could mean as soon as next April, the new tax year, you could find yourself paying 10% on nothing, because Entrepreneurs Relief may have gone, and rather than 20% main rate, that could be anything from 30 to 45% on a tapered basis, which of course, for an owner manager selling a business for 1, 2, 3, 4 million pounds, that will have a massive impact on post-tax proceeds, and therefore to ignore tax would be a mistake, because what we do know is capital gains tax is increasing. Sadly, what we don't know is when. We know that there'll be an autumn budget in October. We think we'll have a roadmap then as to when CGT will increase. We think increases will start next April over a 1 to 2 year period. But for sure, that means if I have a client who has always wanted to see their business sold and they were planning to potentially go to market next summer, I would encourage them to ask whether bringing that forward would be the right thing to do. And then, of course, I guess the last thing that can help you decide when the time is right is the market. Where are we economically? And of course, now, arguably, is a really interesting time because a lot of sectors are seeing a significant amount of bounce back. I think we're seeing a lot of confidence. and on the assumption the vaccination rollout continues to be successful, then actually economically, I think the next 12 to 18 months are going to be incredibly positive and therefore actually arguably the right time to anticipate a transaction. So those are the things that should be on your mind when you're thinking about when is the right time. And in terms of how long a transaction typically takes, I thought it would be worthwhile just setting out a timetable. I mean, these things are fluid, but typically what we find is once we've been engaged to advise the shareholders of a business, maybe on the sale of a business, be it to a trade buyer or management, typically it takes 6 months from engagement to getting to a position where we complete the transaction. Ordinarily, however, in a privately owned business, where the shareholders still are involved in the running of the business and the business is of a size, normally the buyer would not pay 100% of the value on completion of a transaction. Ordinarily, the buyer would pay to the shareholders 60% of the value on day one, with 40% of the value being earned out and paid contingently based on the future performance of the business. And the buyer would expect, clearly, the business to demonstrate its ability to maintain the level of maintainable earnings that has been used for the purposes of valuing the business. And often the earnout can be a sort of 12 to 24 month earnout period. So what that actually effectively means is, if you want to have retired, and that means not only have you sold the business, but you have physically resigned as a director and no longer are involved on an employed capacity in the business by a given date, actually that could take 2.5 years to achieve. And therefore planning early is so very important. We've talked a little bit about capital value, and we've talked about how capital proceeds are taxed. But I think for sure, the two things just worth flagging here are, we will not see the current level of capital gains tax for long. And once CGT has increased, sadly, I don't think we will see this level of CGT for a very long time. And therefore, that is driving a lot of M&A activity. The only other thing just worth mentioning is how you currently extract value from your business. So there's a bit of tax planning here. So let's say you are the sole shareholder of your business. And let's say currently, each and every year you draw dividends of 150,000 and you pay income tax on that at a higher rate, which can go up to 47% effective rate. What you could do if you think in the next year to two, you are likely to go through a capital event. And that can involve not only a sale to a trade buyer, it could involve you selling the business to your employed MD. It could involve you selling the business to your business partner. So these transactions can be often internally administered, is my point. But if you think in the next year or two you're likely to transact and sell shares, then what you might do is, rather than taking a dividend of 150,000 this year and next year, so taking 300,000 pounds out and paying income tax on it, what you might do is not draw a dividend at all. Leave that 300,000 pound of cash in bank, because of course, fast forward 2 years, when you sell your business, that 300,000 pound is cash that would positively impact equity value, as you now know, and therefore you would extract that 300,000 pounds as a capital sum, and you'd pay either 10% or 20% on it as CGT, rather than income tax, which can go up to as high as 47%. So again, a little bit of tax planning there, but all of my clients who sell a business will not, for a period of time, draw dividends. And if they're going to draw cash because they need access to cash, they'll do it through a director's loan account, because again, that can be neutralized as part of a transaction. And therefore, any extraction can be treated as a capital extraction. So do just bear that in mind, because that should go to timing. So in terms of how you can actually sell shares in your business, so there's a number of options. The first is a trade sale. So you could sell your business to a Rightmove or a Zoopla. And of course, in a trade sale, often full value is being realized as a consequence of you selling your business to a strategic buyer who sees huge strategic value in acquiring the business. And of course, likewise, because that buyer can see the synergies, the cross-sell opportunities that are pregnant within your business as part of their group, then they are likely to pay full value. And therefore, that is often why a trade sale could be a preferred option. One of the challenges, or one of the things that often doesn't sit well when selling a business to trade, is the fact that legacy can be forgotten. You know, a trade buyer can often change the business they buy. They can rebrand it, they can integrate it, they can make head changes, they can make redundancies. And of course, these things might be things that you wouldn't appreciate or respect. Similarly, with a trade buyer, naturally, they will carry out very detailed financial, tax, and legal diligence on the business, which presents a transactional risk because, hey, you know, many transactions get into exclusivity and fall down during DD. And therefore, with a trade buyer, naturally, one has to be well positioned to go into a transaction, which is why earlier we talked about making sure your business is always ready to respond positively to an approach, even if you never actually intend to see the business sold. The other thing worth bearing in mind with a trade sale is that often a trade buyer will want a proportion of your consideration to be earned out, and therefore that is contingent on future performance. And you can imagine there's a lot of difficulty there, because if you are going to receive value in time based on the future performance of your business, you naturally don't want the buyer to do anything to your business that could negatively impact profitability and in turn your earnout. But of course, the buyer is valuing and buying your business because they want to develop it, they want to scale it, they want to increase headcount, which could negatively impact profitability and earnout. So there is a lot of time invested in negotiating vendor protections so that the vendor, you, wouldn't be negatively affected by changes the buyer could impose when it comes to the earnout consideration you receive. So it can be a complicated transaction. Of course, the second option is you could sell the business to your management team, you know, the individuals within the business you've nurtured and developed. Because your management team arguably know the business, run the business, then they might not look to carry out any due diligence themselves, which deals with the risk I've just highlighted with a trade sale. And because they know the business and arguably have the same knowledge as you, then actually they would definitely, as a buyer, expect you to give fewer warranties, because they can't expect you to give warranties over things that they know about. And therefore, with a management buyout, you will find yourself as seller giving fewer warranties than you will do to a trade acquirer, which again is attractive to you. An MBO is often a much quicker process, and the risk of success is much higher than a trade sale because you're selling to individuals you know, you trust, and you can control. Whereas selling to a PLC is fraught with uncertainty. The challenge with a management buyout is, of course, it is very difficult to initiate an MBO if you don't have an able, experienced, backable management team who've got the desire to acquire the business. And I must say, most SMEs think they've got a good SMT until that SMT is put through their paces. And very quickly, what you find is they're just very good, loyal staff, but not a senior management team who have the ability and experience to run a business. And therefore, sadly, a lot of businesses who I speak to who are anticipating an MBO will probably acknowledge and find that they will never be able to complete an MBO unless they develop and supplement that management team. And that can be done by, you know, working closely with John and the team at RTC. That can be done by bringing into the business a NED or a business coach to develop, you know, some of your less experienced members of management. The other thing that is challenging in an MBO is how your management team would fund the acquisition, because of course, naturally, a management team, you know, won't have deep pockets. they may absolutely not have the appetite or ability to take significant financial risk. And therefore, they're going to have to be bringing into the business a third-party funder, be it a debt provider or an equity provider. And therefore, as a consequence, what you often find with a buyout is, whilst there'll not be necessarily an earn-out, which the seller has to participate in, there will often be an amount of value deferred and paid out over a period of time, often as a loan note instrument. So effectively, you become a bit of a debt provider to the management team, but you can get a yield on that. And I guess, let's face it, £500,000 earning 8% is better than putting £500,000 in a current account with Barclays at 0.1%, which is your alternative option. So definitely MBOs and MBIs are easier transactions to execute and manage, on the assumption that we have an experienced senior management team who are likely and able and have appetite to acquire the business. The third area is family succession. Is there within your business, a family member or a child or a brother who potentially would be able to buy the business? If so, of course, that makes for an easier transaction even than an MBO, because you're selling to your children or you're selling to your brother or family members. And as a consequence, less costs are involved, and it's definitely a lesser disruption. Obviously, the challenge with selling to family or dealing with their family succession is sort of family tensions. Is it the right person to control the business? Is it on merit or based on blood? Is there a number of individuals that might feel they are more worthy? Is that individual respected by the employees in the business, etc.? And of course, it might mean you don't necessarily receive full value, because selling a business to a management team arguably is you not selling a business to the right strategic buyer, and therefore that could have a negative impact on the valuation you achieve. The final of four is employees, selling the business to employees, but through an employee ownership trust. So rather than selling the business to the MD, which is a management buyout, you can actually put the business into a trust, and the trustees will be, and the employees will be the beneficiaries. In the instance of an employee ownership trust, all of the employees become beneficiaries. They all therefore have a real, commitment to the business. Of course, they likewise, therefore, are a buyer known to you. What a brilliant way to reward people for their years of service. And of course, what a great way to pass the legacy down. The great thing about an EOT is you pay no capital gains tax on the proceeds, which is a big win if you've got a business that has real value, especially if CGT in 3 years' time is materially higher than it is today. The challenge with an EOT is threefold, actually. The first is, clearly, you still need in the business a management team to run the business. The second is, often the value will be realized over a much longer period of time, because an EOT structure finds it more difficult to bring in leverage or funding than a new co, which would be set up by an MBO team. And therefore, often the seller gets value over a much longer period of time, which again is fine for some people. The third and final, which is really important actually, is with an EOT, all of the employees have to be beneficiaries. What you can't do is say, right, of my 50 employees, I only want the MD, Bob, to be the beneficiary. That wouldn't be an EOT. And therefore, that's just a management buyout. And of course, in an MBO structure, you pay normal CGT. So the reason an EOT is not for everyone is because all of your employees will become beneficiaries. You can, of course, structure the way in which those employees benefit proportionately to seniority, ability, contribution, length of service, etc. But in an EOT, your MD and your T-boy will all have entitlement. And therefore, is that appropriate? Would you want, your cleaner, your exec assistant, and your MD all to be beneficiaries of the trust? Of course, John Lewis would say yes, but not every business is John Lewis. So, how can you decide which of those options is the most viable option for you? And of course, the answer is it entirely depends on your circumstances and what you want from your business. Naturally, as advisors, we're here to help you understand what your business today is likely to attract in terms of value, how you can improve the value of your business today and over the months to come, whilst also assessing what options are available to you, acknowledging that if you are likely to want to pursue an MBO, we've got to make sure, don't we, that the MBO are backable. A funder would support them, and therefore, how knowledgeable, how experienced, how able are they? Have they got a business coach who are working with them to help them appreciate what governance is? Do they receive monthly management accounts? These things take time and can be done with time. So absolutely, as advisors, we are very focused in on making sure we lift the bonnet, assess the options that are available to you, and then helping you establish which options are the right options to pursue. Accepting that, we often find ourselves running a dual track process. So it's not uncommon that a client would say, right, I think that we will achieve greater things and a much heightened value if we sell our business to a trade acquirer. And we think our trade acquirer could be A, B, C, or D. And therefore, we want to position our business for sale. However, we have a really good management team, and we would be receptive to selling the business to management. In that instance, what we might find ourselves doing is, yes, talking to trade buyers, soliciting indicative offers to see whether those offers are interesting, but simultaneously talking to management about how maybe they could go about becoming more involved in the running of the business in anticipation of a potential trade sale. Accepting that, we may also, depending on the outcome, want to consider some sort of partial equity participation for management, be it an MBO or otherwise. And fundamentally, the key message that I'd love to sort of try and close on is the fact that you spend every day, I'm sure, of your working week thinking about, planning for, and working in your business. And therefore, it is, for me, so important that you spend the time to consider how you are likely to want to go about realizing value in the future so that you can make sure the business is well poised to realize full value at that time, bearing in mind you'll get one opportunity to extract value from your business. And therefore, you want to make sure that when you do it, it's the greatest transaction that you could have executed and that you executed without regret. We talked earlier about certain things that you can do when planning for an exit. And I don't think I'll run through these in detail, but for sure, we've talked about reducing dividend extraction. Maybe if you require cash from the business, you can draw it through directors' loans. If you've got any non-business assets on your balance sheet, extract them early. That can take time, especially when you're dealing with leasehold property. So like if the business, for instance, has an apartment, which is like a residential apartment, and you own it through the business, but it's like a long leasehold, that can take 6 months to extract from a limited company because you've got to get consent from the superior landlord. Do it early because the buyer won't want that investment property when they purchase the business. I think the other thing, guys, that sadly most SMEs are guilty of is inadequate financial reporting. So please make sure that you do have monthly management accounts, P&L balance sheet. Do start tracking things like adjusted EBITDA, because your operating profit means nothing. It's the adjusted EBITDA number that matters. Start being more interested in the balance sheet. What's your net cash position? How can you improve it? And of course, please make sure that you're sort of diligence ready. So do your employees have employment contracts? If they don't, let's put those in place. Do you as a business have your customer contracts in one tidy file? If not, let's gather them and collate them so that, of course, at any time in the future, should you find yourself receiving an offer you can't help but consider, you are diligence ready. And as we discussed earlier, typically from this discussion to seeing your business sold, it can take up to circa 24 months, and therefore for sure, planning is absolutely key. So in summary, planning is everything from our perspective if you are to optimize the outcome of what will often be the most significant transaction of your entire life. And that sounds extreme, but it's often very much the case. And I have the pleasure every day of helping owners of SMEs who have built great businesses over tens of years realize that value in transactions that could often deliver tens and tens of millions of pounds, and also, hundreds of thousands of pounds, because, what is important is the relative importance of the transaction to you. And therefore, let's make sure when it's your time, you are well prepared. Do please make sure that you do everything you can to improve the business's maintainable earnings. Let's be very cost conscious. Let's be very margin protective. Please make sure you know what your maintainable earnings are. Most owner managers don't. Do everything you can to improve multiple. Rather than sell your business for 4 times profit, let's sell it for 6 times profit. The difference is life-changing. Do try and increase cash. Don't let cash stay within debtors. Try and extract it sooner. Be better at credit control. Offer customers early payment discounts to the extent it's appropriate. The other thing that does have an impact, difficult to quantify and quite intangible, but it has an impact. Be visible to your ultimate acquirer. And by that, I mean, be a thorn in the side of the businesses that you think likely will want to acquire you in time by putting out relevant, structured press releases. If you've just developed and launched a new piece of technology, make sure the market knows about it. When you recruit new heads, make sure the market knows about it. When you enter into a new contract with a new customer, and it's a marquee customer, let's do a client testimonial. Point is, the perfect time to sell your business is to the strategic buyer who you have invited to approach you, but without tabling an invite. Because at that point, you're reluctantly willing to have an off-market conversation, which is what we did when we sold Van Mildert to Rightmove. And that has a huge impact on the way the transaction is navigated, the negotiation that takes place, and the valuation you receive. And arguably, that's one of the easiest things to do. I think finally, as a friend of John's and as a friends of RTC, myself and RG, as a large firm of accountants, auditors, tax advisors, and CF advisors, we're always on hand to give you pro bono advice. We're always here to answer a question. If there is something you want a second opinion on, just reach out, because I'd be delighted to think that I've helped you in planning and preparing for whatever might be your ultimate event and whenever that might be. So I hope that's been interesting. I hope you've took away 1 or 2 little bits that hopefully will help you and your business. And of course, I guess before we wrap up, I'd love to open the floor to any questions that haven't naturally come out as we've gone.
I'll ask one, Carl. Excellent presentation. Thanks very much. It's Toby Bridges, MBT Group. Just regarding the employee opportunity, how do those deals usually get funded?
Good question. So ordinarily, they would be funded by conventional bank debt. There are now some tertiary lenders and debt funds who are willing to provide debt to the trust structure. But I must say EOTs, even though they've been around for a long time, they have not been utilized fully. And therefore, a lot of lenders still aren't comfortable lending to that trust structure. Yeah. And the consequence of that, that's a really great question. So the consequence of that, and therefore the reason why we see few EOTs, is because right now, most clearing banks would provide sort of 2 times EBITDA leverage to fund an EOT. And therefore, if your business were to be valued at 6 times EBITDA, and you sell that business to the EOT for 6 times EBITDA, actually what you'll only be getting on day one is 2 times, with 4 times as a loan note over a very prolonged period, because the bank is likely to want their loan repaid before your loan note could be redeemed. And therefore, you've got to be a very supportive seller to find that attractive. And that compares to a traditional MBO, whereby a debt fund or a tertiary lender will support, providing leverage of between sort of 3.5 and 5 times EBITDA. And of course, that means in an MBO, the shareholders receive much more of their value on day one.
Does the EOT have to own the whole of the shareholding, can it, or could it be a partial shareholder?
Great question. More than 75%. So that therefore means you could, you know, if you were inclined, you could retain a minority position.
Yeah. Thank you.
Pleasure.
Hi, Carl, it's Adrian.
Hi, Adrian.
Thanks for that. That was really good. Question, just jumping back to the, following on from the earlier ones regarding contracts.
Mm-hmm.
We're in a position where we work in a sector where we effectively have corporate 0 hours contract. So we might have a contract with British Gas, for example, for 3 years, but there is absolutely no guarantee of volume. Historically, you can demonstrate that, and you can demonstrate what you're doing now and forever. And I just wondered whether that was something that would be immediately flagged, or there was any acceptance of that scenario. We're in a position where we're generating new revenue streams and products that will have different contractual relationships that will be more beneficial to that. But at the moment, the bulk of them come from a sector which does not commit the volume because it's reliant on government policy.
Yeah, no, it's a great question. And I think the answer is, obviously, it's great you've got contracts with key customers. It definitely demonstrates their commitment to working with you and your business. And that clearly, you know, is valuable. Because, however, those contracts don't have a minimum level of revenue attaching, sadly, that will therefore naturally mean we don't have any visibility of revenue. But the existence of the contracts in themselves, Adrian, is a good thing.
Mm-hmm.
Yeah, but sadly, that means, you know, you are not a business that has contracted revenues, and therefore that sadly, you know, will not necessarily be additive when it comes to multiple.
That's what I suspected, but thank you.
No worries, good question.
I've got another question. Sorry, all the questions. Really interesting. That's fabulous. Thank you. So in my dream scenario of selling my business to Rightmove, at the moment, it's much harder for me to build my business quickly because reaching the audience is quite hard. But I know there's 20,000 estate agents I could sell my product to.
Yep.
By selling to Rightmove, the exponential growth would be massive on the basis that you'd see that. So how does that affect your value? Because obviously my value now compared to what they could generate with their network would be dramatically different. Does that benefit me, or what do I do to protect myself from that?
It's a really good question. So I think the two things to acknowledge are, first of all, you know, a Rightmove would not necessarily allow you to benefit greatly from the value that they would leverage from your business, because that's value for them.
Yeah.
That's the first sort of thing to sort of acknowledge, if you will.
Yeah.
However, what it does mean though, is if we can help Rightmove see how they would leverage your business, that in turn will help us encourage them to place a more fuller value on your business, because they can see their payback.
Yeah.
Therefore, you do benefit, but indirectly.
But I need to go a bit longer, I think.
Yeah.
Business value. But it's a tricky one, because we're talking to them and one of the other portals, which is fantastic. But as I've been a bit more blunt than you suggested. I said to Rightmove, I think you should buy me, but I'm too cheap at the moment, so you can't have it yet. So over time, I'm hoping that it will be worth them buying me.
Yes, no, well, it will, and we're currently advising on the sale of a prop tech business, which is one of the largest privately owned CRM providers to the sector, and we're talking to On the Market, Zoopla, Rightmove, Boomin. I mean, we're right in the middle of that big transaction, and all of the things that you are sort of asking me now are the things that we're discussing, actually, because my client wants to see their business part of a larger group, because we know we can cross-sell our software into the client base of Rightmove.
Exactly right.
And we know what that will mean for Rightmove, and therefore, whilst we don't expect the buyer to deliver to us the value they will achieve, otherwise clearly there's no reason to buy the business, there needs to be an acknowledgement in the strategic value they will get from buying the business, and therefore that goes to multiple.
And you factor in with that regulation may also come in, and every estate agent has to have a qualification, which we offer.
Correct.
That then is quite powerful, but it's all the what if scenarios at the moment that are quite tricky to deal with.
Well, that's exactly it. Exactly right, Charlotte.
Carl, Gail asked a question in chat relating to employee trust and what would happen if a staff member left during the process of the sale.
During the process
of the sale.
Yeah, okay. Well,
in other words, if they left at some point in time while the sale was transacting.
Well, they would, of course, no longer be an employee and therefore no longer be a beneficiary of the trust, John.
It's an interesting one. Adrian and I, ironically, have both worked for an employee-owned organization that went to IPO. So if you left before the sale and you were an owner, you would have given up your right to ownership in that business when you left, in our example. But after it went to IPO, money has been held in perpetuity for anyone who was employed in that time.
Yeah.
So the company then got sold 3 years later to Carillion. There's 5,000 people that are in a perpetual trust that still get benefits to this day, 10, 11 years later, and will for the perpetuity of the trust. It's very much on the rules, the structure of each individual organization, in my view.
Yeah, no, well, that's right, John, and that was very generous of that company to approach it that way. But you've highlighted one of the challenges with an EOT. The beneficiaries of an EOT find it very difficult to benefit, other than from income, because of course very few EOTs would be acquired for all of the reasons you've highlighted. Because of course, if you're acquiring an EOT, who gets the consideration? How do you lock in the key individuals? And of course, if every employee is getting tens of thousands of pounds, including very junior members of staff, does the buyer of that business watch the business dissipate overnight as all of these individuals become overnight millionaires?
100%. And in our case, in the IPO stage, staff got between 4 times and 8 times their annual salary net of tax for all obligation, right?
It's huge, isn't it? For an employee?
When Carillion bought the business, the money goes into trust. No, Adrian, I stand under corrections, with 300 million pounds in that trust, or 250 million. If the trust was dissolved, the money goes to charity. It does not go to the beneficiaries of the trust. Wow. So you either a trustee and you take your whatever comes your way, or it goes to charity if they ever dissolve it. But the employees did not get a 200 odd million divided by 5,000 scenario.
Yes.
Because that's the way it was set up. Now, not all businesses work like that, obviously.
That's right. It'll all come down to the trust deed, the EOT trust, and there would be trustees who would govern how the trust works. Toby, you asked a great question earlier, and I've just been reflecting on it. So just to clarify, so I think you asked, could a selling shareholder still have equity in the EOT? And I said yes. The only thing I just wanted to add as a point of detail is that for you to have an ongoing interest in the trust, you would have to have less than 50% of the voting rights as well. just to make that clear, because that's often something that can create a challenge, i.e. someone will say, well, I'll retain 25% of the equity, but I want the equity to have a disproportionate amount of voting allocation. Of course, that's not possible. The point is you'd have to be a minority in all truest of sense, including voting, etc. Okay.
And that brings its own challenges, because you brought up John Lewis. It's a good example at the moment, because obviously it's employee owned. They appoint a board of directors who operates John Lewis, and in crunch time, sometimes the director's obligations in terms of running John Lewis don't necessarily coincide with the employee's view of how it should be run. So all these things are great opportunities, but they bring their own challenges in different scenarios.
That's right. And of course, the trustees report to the beneficiaries, the staff. Right. Which, of course, unless, everyone's different, but, you are definitely putting a lot of control into the hands of employees, and therefore make sure they are the right employees to be in control. Yeah. Guys, conscious of everyone's valuable time this morning. Any other questions or observations? I mean, obviously after this session, John, I'm sure you'll circulate the slide deck for boring bedtime reading, but any final questions, guys, whilst we're together? Excellent.
Really helpful.
Let me go on, Charlotte.
No, so it was really helpful, really good.
Yeah, really enjoyed that. Yeah, really helpful.
Cole, let me wrap it up for you then. So Cole has worked with me with a couple of clients. And the nice thing about Cole, and there are other corporate finance companies, I mean, it's fair to say.
Absolutely.
About Cole is sometimes I'll have a private conversation with him and he will go, yeah, I don't really want to meet that person, and I kind of understand why before I even have the conversation. But he will often meet with the clients, he said, out of investing his own time, and have a really helpful conversation with you. And he's also helped me conclude an MBO, I think it was a 7-figure MBO, just earlier this year. So corporate finance, as you guys know from speaking to scale-up partners, every now and again we will say you need to go and speak to a corporate finance company, because an accountancy firm, unless they have the corporate finance elements, in my opinion, can't do all the feasibility and some of the diligence that a corporate finance specific area of an accountancy firm does. And that's why you get the recommendations. So I just wanted to thank Cole for making his time. I know he's a busy man. And thank you all for attending.
Yeah, likewise. And thank you, everyone. It's been great to meet you. I've really enjoyed the questions that you've each asked. So thank you so much, guys. And if you have any questions, any points that you'd like to discuss, or indeed if you'd ever appreciate a confidential discussion, either contact me on LinkedIn, or I'm sure John would be delighted to sort of formally introduce you.
Brilliant. Thank you.
All right. Thanks.
Great.
Thanks, everyone.
Thanks, everyone. Thank you.
Have a good
Thank you so
weekend.
much, guys.
Thanks, Carl.
Take care. Bye.
Thanks, guys. Bye.